Welcome to the Big Success Show. Today, the best investment strategy for normal people.
You're overwhelmed, so much to do. It seems like such a mess. If only you had coaches who could bring you big success. Bring you big success. So lean right in, learn how to win. Entrepreneur nurturing. Tips to be your best. With a professor and Mary-Lynn for your big success.
The best investment strategy for normal people?
Yeah, wait, are you not normal?
Well, I think I am, but there may be people out there who would beg to differ. By normal, what are we talking about? We're talking about those non-financial types, right?
Oh, yes.
It means,
so folks who just, I've got a 401k and I don't really know a whole lot about it.
Exactly. And I don't really get this whole money, money may be kind of a mystery. I don't love reading stock charts and all that kind of stuff. For those kind of people, the good news is what we're going to talk about today is your best investment strategy. And the good news is, more good news, it actually delivers, it's simple, but it also delivers really good returns for the risk that you're taking.
And the show for today was inspired by the recent fluctuations in the stock market, but there's always fluctuations in the stock market. So this is a show you can come back to time and time again.
Absolutely right. My name's George Kruger. I'm the professor.
And I'm Mary-Lynn. So, George, is the stock market haunted?
Haunted?
Because we always seem to have this issue around Halloween.
Well, we do, and we're going to actually talk about that very issue. We're going to show you how to shoo the ghouls and the goblins away.
Ooh.
And also help you gain confidence in your investment decisions.
So today, we're going to talk about what's the best investment strategy for non-financial people.
We could almost say it's what would Warren Buffett do if he were a normal person.
So a non-financial person could be like Warren Buffett?
Yes, if he were, he's answered this question. If he was a normal person, he tells us what he would do. We're going to share that with you today.
As it turns out, he is a normal person.
Well, yes, that's probably true.
You just said if he wasn't.
Well, no offense. He's not. He's a pretty normal guy, but he's done some very extraordinary things.
There you go. I get that. All right. So why don't we start with this, George? Why do stocks crash so often in October?
Well, actually, Mary-Lynn, they don't.
Oh.
Isn't that interesting? So this is a myth. I mean, we all think, and even I think people who are very in tune with the financial world think October is the month for stock market crashes. And I think it's because some of the biggest, most memorable crashes have been in October. So like one of the big ones, in fact, the single biggest decline in history occurred on October 27th, which was Monday, October 27th. It's called Black Monday. And
what year was that?
1987. The stock market lost a fourth of its value, roughly 22% of its value, in one day, just one day.
Wow.
So also, if we go further back in history, all the way back to the Great Depression, which we all remember, was kind of started or certainly accelerated because of the stock market. Well, the stock market actually we've had three crashes in the stock market: Black Thursday, Black Monday, and Black Tuesday. And those, as I said, kind of sparked the Great Depression.
It was back in 1929.
Yes, back in 1929. But the interesting thing is two things. One is there's a great calculator over at the Money Chimp website.
Money Chimp.
Money Chimp. We've got the link on our blog. And they've analyzed 70 years of S&P 500 data. And what they found is that on average, or over time, October has been positive more often than negative. The month that you really want to watch is actually September.
What happens in September affects October, and then we blame it on October.
Exactly. So we have the September, fall comes in September.
Yeah.
So there you go. It's not so scary in October, but the fall comes in September. But the other good news about October is this: that October has signaled the end of more bear markets than the beginning of a bear market. To just make sure everybody understands, a bear market means the market's gone down. It's in it's down at least 20%, and so it's operating in negative territory for a period of time.
Okay. What is market timing?
So market timing is an investment strategy where someone tries to predict the up and down movements in the stock market. So the stock market as a whole.
And is that a good strategy?
No.
Okay.
Here's what I'd say. No for non-financial types. No for normal people. And questionable even for financial types, because what has been shown over time, and we're going to talk about some of these things, some of these studies, even the pros have trouble beating the market. In other words, just letting it ride. Okay. So for non-financial people, market timing is a horrible investment strategy.
So really, just leaving my 401k alone, no matter what happens, whether the market's doing well, the market's doing bad, that's okay?
That's good, except for as you start getting closer to needing the money. Okay, so generally it's recommended if you're going to need the money in 5 years, maybe even 10, you want to start backing down on your investment in the stock market and putting it in something that is less likely to have this same up and down type of fluctuation.
But if you're young, you can take
Just
greater
let it
risk
roll.
and you can just let it ride.
Absolutely, because time and history is on your side.
Okay. And you have 3 studies that illustrate why market timing is not the best investment strategy to use.
Yeah, because market timing, when you're trying to time the market, you risk missing those really good days because, it seems like a lot of the returns in the stock market are kind of clustered around a few days. And those few days each year make a big, and that is big with 2 big G's, a big impact. So the first one, the great series it's called the 12-Step Recovery Plan for Active Investors over at the Index Fund Advisor site. Love the whole series and love their sense of humor. Active investors are people who try to time the market, among other things. But they talk about a study where if you assume that you invested $10,000 and invested it in the S&P 500 index, which is just a broad index, it's the index kind of the 500 largest companies in the country. If you invested that $10,000 and then just let it ride for 20 years from the beginning of 1998 to the end of 2017, that $10,000 would have increased by $30,000 plus a little bit. So you would now have over $40,000.
Even with the hit we took in, what was that, 2016, 2017?
2007, 2008. And then, there was another kind of minor correction in 2017. Yes, with all the corrections, all the ups and downs, if you had just let it ride, your $10,000 would have turned into $40,000. Okay? But now here's the thing. If you happen to be timing the market and you just happen to miss the 5 best days, 5 out of 20 years of data. So think about that. I can't even do the numbers in my head, but I mean 240 months. And in a sense, out of that 240 months, just 1 week is 5 days. If you did that, then instead of your 10,000 turning into 40,000, your 10,000 only turns into 26,600.
Wow.
So you lose, your return is 45% less. The amount of money you gain is 45% less, almost half, just by missing out on 5 days.
Wow.
So
5 days out of 20 years? That blows my mind.
Yes. It's crazy.
And there's no way that you would know. I mean,
No.
there's no way.
Because, like right now today, what's the stock market going to do today? Don't know. What's it going to do tomorrow? Don't know. And that's the whole point to if you're trying to time the market, you're fighting all of this. There's another study conducted, actually it's funded by Townley Capital Management.
And just to let our listeners know, we've got links to all of these studies in our show notes today. So you can, don't worry and try and jot everything down. We've got links directly to it so you can go back and, reference these things later.
So University of Michigan professor Nayat Sayan, I hope I'm saying his name right, did this study. And what he looked at was a diversified portfolio of U.S. stocks from 1926 all the way through 2004. Okay, so that's, I think, 79 years or something like that. So had you invested $1 in 1926 and just let it ride, it would be over $1,900 in 2004. $1 turns into $1,900. But if you had missed the 12 best months, okay, there's 948 months in this period of time. If you had missed the 12 best months out of 948, okay, you would only have $197.
Wow. Oh my gosh.
Out of every dollar. $1 becomes $197 versus $1 turning into $1,919. Wow. In other words, 90% of all the gains in the stock market came in just 12 months over that 948-month period. Now, I dare you to think about the next 948 months and try to figure out what are going to be the 12 months that are the best. You can't do it.
No.
So that's why market timing works against most people. All right. So got time for one more, Mary-Lynn?
Oh, please.
So JP Morgan, I mean, I hope this is sinking in because, I mean, what we're really trying to do, I know it's hard when we're just saying these numbers. Once again, all of this is on the blog, so you can read it for yourself and be able to, understand it maybe a little bit better. But I hope you just, your reaction, Mary-Lynn, is perfect because I think that's how I feel.
Well, I'm getting the bottom line.
Yes.
The bottom line is that you have to hang in there for the long term.
Yes.
Because a little bit of time makes a big difference.
Well, and this last study is really, I think, indicative of how hard it is to time the market. So It's a study by JP Morgan Asset Management. They looked at the S&P 500 from 1995 to 2014. So just try to absorb these numbers. 6 of the best 10 days over that time happened within 2 weeks of the 10 worst days.
What?
So 6 of the 10 best days happened within 2 weeks of the 10 worst days. So in other words, the market, and I think this is what we're seeing, like during the Depression, the market took a long time to recover, but we've gotten smarter. We've evolved. We've learned. And so markets tend to recover faster these days. And I think that's what this is showing us. 6 of the 10 best days occurred within 2 weeks of the 10 worst days over that 10-year period of time. So once again, when the market's going down, man, if you bail out, you're probably selling low and you're going to end up buying back high, which is exactly the opposite of what we want to do. So the whole point here is market timing is not a good investment strategy for normal people.
Right, because who can time it?
Exactly.
So that's really that just incredible points. So then
I will just add one more quick note.
Yeah.
As I get to walk through the hallways of our esteemed institution, the University of Illinois here in Urbana-Champaign.
Yes, the professor.
And I see all of these, finance professors, the guys who are in this stuff all the time. It's interesting. If you ask every single one of them, the bulk of their portfolio is not market timing.
Not market timing.
No, it's what we're about to talk about.
Which is the best investment strategy for normal people. What is it?
Exactly. Well, according to Warren Buffett, it is to do the following. Keep investing, particularly when the headlines look bleak. Keep investing, particularly when the headlines look bleak. The key thing for you to take away here is keep investing. Keep investing. And it's impossible to predict what's going to happen in the stock market today. It's impossible to predict tomorrow, this week, next month, next year. But what we do know is that stocks have historically gone up over the long haul.
So even when you're turning on the news and they're just saying, oh, everybody's 401ks are taking a hit, and that's all you hear.
Yes.
Just don't do anything.
Don't do it. Yes.
Okay.
And if you remember, even
which again depends on your age, right? But if you're older and getting closer to retirement, you're probably not putting most of your. I mean. Yes.
And the point though is the danger lies when we start tweaking things based on our emotions about stocks.
Okay.
That we're scared that they're going to go down, or that
they're going to stay down,
or that they're going to stay down. Yes. So the person you're describing, Mary-Lynn, so we're getting close to retirement. Well, regardless of the stock market, we should be moving assets into safer assets.
So there are financial advisors already kind of moving them along, kind
Exactly.
of out of that situation.
Yes.
Okay.
And I'm glad you just said that because I want to emphasize a point here. We're talking generalities here, so you got to understand this is in general. Okay. We're giving you the best information we have in general. But we highly recommend working with your local financial professional to help you understand better and also to maneuver given the specifics of your situation.
Okay.
Another thing that's important to understand is the past is not necessarily an indicator of the future. But since the beginning of the stock market has drifted up over time. And that's what I think we just all have to understand, that this idea of just investing long-term, buying and holding, that's your strategy. That's the best investment strategy for normal people, and it leads to big success.
And that brings us to today's big takeaway.
The best way to buy low and sell high is to buy at the market and be patient.
All right. Well, as we've said, that was a lot of information today, a lot of numbers, a lot of studies.
I love the numbers.
And we've got all of the resources, links to each and every one of the resources we talked about today in the show notes. You can find the link to the show notes with this episode in your podcast player. Just click the link and you'll be right there.
And we thank you so much for listening today. You made us feel like normal people.
Yes. Until next time,
Here's to your big success.
Tips to be your best with the professor and Mary-Lynn for your big success.
Find big success at biggsuccess.com.